Welcome to part 2 of the ultimate guide to term policies. Now in the first part, if you have not already watched it, I suggest you go and watch it now. We talked about the different types of policies, including increasing term, level term, decreasing term. And now we're going to talk about group term policies versus personal term policies, as well as how to pick a sum assured and the tenure of coverage. Oh, and before we start, usual disclaimer, this is not personal financial advice. Anything you view in this video, please go and seek your own second opinion. Go and do your own due diligence and research because you are the best financial advisor for yourself. Now, group term policies can actually be a level term, can also be a reducing term, can also be an increasing term, etc. So, what's the difference between a group term and a normal term policy will be the ownership of the policy. When you sign up for a term policy with one of the insurance companies, you are the policy owner and you sign a contractual agreement with the insurance company. So as long as you pay a premium, the insurer is obliged to cover you for as long as the tenure is stated on the contract itself. But when it comes to group term policy, the contract is between the insurance company and the organization that has signed up for the group term policy. A very popular group term policy in Singapore would be the MINDEF and Singlife Aviva policy, which allows national servicemen to sign up and get covered for death, TBD, critical illness, even disability income insurance at the group prices. SAF Group Term policy is an increasing term policy. As I mentioned in part 1, it has its advantages and disadvantages. So you should watch part 1 if you want to know more about that. So as you can see, the premiums increase as you cross different age bands. So that might or might not make sense for you depending on what you want from your coverage. If you sign up for such a coverage, the contract is actually between MINDEF and Singlife. So if they make any changes to the contract, as the person who's not the policy owner, I don't think you have a say in it. I'm not very sure, I need research on this point. So I checked with Singlife and Singlife mentioned that the T&Cs are fixed at the time of purchase. And in the unlikely case where MINDEF does not renew with Singlife, a new insurer will take over the coverage and provide coverage at the same or better terms than the current one. So people who are insured under MINDEF and Singlife, you need not worry about terms and conditions changing. But for other group policies, do check your terms and conditions. Also, because you're not the policy owner, you can't actually make nomination to your beneficiaries, which means you need a grant of probate or letter of administration for your funds to be smoothly distributed to your proper claimants, and that can take upwards of 6 months to even 3 years as stated on their website. Moreover, if you compare the premiums, you may find that a personal term policy that you can buy these days are actually not that much more expensive than the group term rates. In fact, I think the group term rates can be more expensive than some of the term policies you can get in the market right now. SAF Group Term policy still remains a very viable option for those who want cheap coverage at a very low cost. Just take note that it's an increasing term policy. Also, it has limitations as a group term policy that personal life policies do not have. But other than that, it's actually really quite cheap during the early ages of someone, so you can consider that if you're on a very tight budget. Other group term policies, of course, depend on their terms and conditions. If your company provides group term policies for you, take note whether or not it can be portable, meaning can you bring it out of your company if you switch jobs? Now, most corporate benefits like that is to prevent you from switching jobs. So I think usually there's a clause to say that if you leave the company, the benefits will cease to exist, even though you want to continue by paying the premiums. So do take note of the portability feature for company insurance like that. So when you want to buy a term policy, what do you look out for? For me, the first thing would be premiums. Usually you can get away with buying the cheapest plan because cheapest does not mean the worst. All insurance companies in Singapore have a legal obligation to pay out if a claim meets the definition within the contract. So premium does not reflect quality of the insurance company. I feel a lot of people think that the more expensive premium I pay, the better and easier I can get the claim. Secondly, if you tag on things like early CI or your disability income insurance, then of course those definitions are a lot more different than death. You need to go and look through and compare between a few quotes to see whether you are comfortable with the definitions presented to you. By and large, I feel that the definitions don't differ that greatly. So what I'll look out for if I were to buy a term policy today would be I will select the assurance amount, the sum assured, and then the tenure, and then I'll compare between a few providers, the cheapest ones, and look at the different terms and conditions and see whether I'm comfortable with the cheapest option. If I'm not, then I look at the second cheapest and so forth, until I find something that is reasonably priced and the definitions don't shock me greatly. How much sum assured do I need is $1 million question, and for some people it's indeed $1 million because they are more risk averse. If something happens to them, they want a big enough amount of money so that their financial dependents are taken care of. But some people are less risk averse and they feel like, okay, if anything happens to me, 200,000, 300,000 ought to do it, and then they just buy that amount. For me, I feel that term policies are cheap enough that you can easily buy $300,000 to $500,000 without breaking the bank, and that should be a comfortable enough amount for your financial dependence if you were unfortunately to pass away, or for yourself if you were to get a critical illness. I think $300,000 seems to be the minimum for such an event. For young parents with kids, obviously you want a high enough amount. I think $500,000 of death coverage seems to be the figure that will make sense to replace about $20,000 per year for the next 25 years. And with inflation setting in, a level 500k will actually reduce in value until your child has grown up and joined the workforce. For individuals who are concerned about critical illness, after you get your disability income insurance, I think you actually don't need a very high amount of critical illness coverage, maybe $200,000 to $300,000. But of course, when a critical illness strikes, the more money you have, the more resources you have, the better for you. You have to balance it against the premium amount. If you consider typical scenarios like kidney failure, cancer, stroke, $200,000-$300,000 of payout will help you to defray increased cost of livings like renovate the home for wheelchair access or go overseas to buy a new kidney. I don't know. Like I said, this is a very difficult answer to question. Very difficult answer to question. This is a very difficult question answer, and it depends on your risk appetite. So if you feel like in such scenarios you want to have a better peace of mind, to have more options at your disposal because you have more resources, then go for a higher sum assured. If you are more risk seeking and you feel like you don't need that much coverage when something happens to you, then by all means go for a lower amount. I've heard some people going for as low as $100,000 to $200,000. I think it really depends on your comfort level. How long to be covered for is also another very subjective question, and typically the longer your term policy is, the higher the premium. So you don't want it to be too long. If you are selecting it for whole of life or even up to things like age 80 or age 70, you're doing it wrong. You'll be paying so much premium, you might as well just buy a whole life policy. For me, I feel that if you are buying for mortgage, obviously you will buy it until your mortgage ends. Let's say a 30-year mortgage, buy a 30-year reducing term. If you feel like you will retire at age 55, I would suggest maybe buy until 60 to give you some breathing space, but that's me being a bit more conservative. I know some people even advise as short as 20 years. My feel is that most working adults, you can choose maybe about 30 years to give yourself some buffer time to prepare enough resources for self-insurance and retirement. Again, this is not personal financial advice. Please consult a financial advisor who will not shortchange you and sell you lousy term policies, or worse, try to upsell whole life, ILP, savings plan, those sort of things. If you want a recommendation, okay, leave your particulars in the Google form below. I will link you up with an ex-colleague whom I think can be reliable and trustworthy based on the number of years I worked with him. So yeah, you can do that if you need advice. Otherwise, you can go online, go to Compare First, do your own comparison, and then buy from there. Yeah. Alright, I hope that this has been useful to you. As usual, if you like my content, drop a like, leave a comment, tell all your friends about it, okay, and subscribe to my Telegram channel, and I'll see you next video.